everyone, I'm Lucy Hockings, and welcome to today's panel discussion on mobilising climate investment through blended finance. And hello to you all who are joining us on the live stream. Really lovely to have you with us. It's good to have people from right around the world joining in today as well. What a powerful video we just saw to start off this session, because we're all aware of the critical role that private capital plays in addressing the pressing challenges of climate change. And to get the ball rolling, I wanted to ask you all a question. So get out your phones or your devices, and I think you all know how to use Slido. The question that I've got for you today is, what do you think the barriers are to private climate mobilisation in emerging markets? So input your words and your thoughts, and we're going to use some of those to get the ball rolling, to get the discussion started today. Because during the panel today, the barriers that we're looking at here, we really want to identify what those barriers are. We want to explore some of the innovative strategies and financial mechanisms that leverage blended finance to unlock climate-aligned investments in emerging markets, in Armenia and beyond. And I think one of the key words that's really going to come out today is collaboration, because collaboration is absolutely vital in driving that positive environmental impact alongside what are tangible financial returns. And I want to collaborate with you all today. It's really important that we have a lively and reactive kind of discussion, so collaboration is key. Please send me your questions as well, using Slido, which you just said. I'm going to be taking the questions throughout the panel, not just at the end, right from the very beginning. If you're not comfortable with Slido, do raise your hand and someone in the room will come to you with a microphone and we will get to you, I promise. I've got people making sure that I notice who is raising their hand. But look at the great words that are coming to us now. Keep them coming while I introduce our amazing panel. I hope on Zoom, with the magic of Zoom between, there she is, between Armenia and Nigeria, is Tariye Gbadegesin. Good to see you, Tariye. Tariye is the Chief Executive Officer of the Climate Investment Fund. Lovely to have her with us. Normunds Mizis is with me now, the Chief Credit Officer from BlueOrchard Finance. And hello to you, Rolande Pryce. She did offer to do an interpretive dance to start off, but I told her that's not quite necessary. World Bank Regional Director for South Caucasus. Harry, you did offer to join her at one point. Are you ready? Harry Boyd-Carpenter, Managing Director of Climate Strategy and Delivery for EBRD. Really great to have you with us. Tariye, you can't see some of the word cloud, and I'm going to come to you in a moment for your response, and I hope you can hear us. Are you there? Yes, she is great.
Yes.
But Normunds, let's have a look at some of the things that people in the room have told us that they're concerned about. And I wonder, when you look at some of the words on the word cloud, which is rather about to come up. There it is. What, when you read those words, really resonates with you in terms of the barriers to climate investment?
I think some of them in a bigger fund, regulation could be one of them, but
I mean, regulations in very big
exactly. But I think
in the middle.
From my perspective, perceived risk would be the one, and lack of awareness. Right? If I had to pick the two, those would be my top picks when we discuss about the potential investment from private sector. And the reason being, I think there's a perception of extremely high risk in emerging markets within the developed markets, and also lack of awareness of the instruments that are available and are beneficial in those emerging markets.
Tariye, one of the phrases right at the top that people have submitted is lack of the right capital. Would you agree with that?
I think absolutely, especially in the context of concessional finance. Concessional finance is such a critical component of blending and for enhancing tools for the mobilization of of private capital. And there is a pretty limited level of concessional finance globally, and things are actually even getting more constrained. In addition, there's a need to allocate concessional capital and the different components of the risk spectrum appropriately to be able to have the greatest multiplier effect on the various capital sources.
Rolande, what jumps out at you when you look at that word cloud?
I think the one that really stands out for me, some important ones were, of course, mentioned by Norman, but for us to discuss something else would be the pipeline. I think that once you have money in place, one of the key challenges that many countries have is actually being able to develop a strong project pipeline that will, that those funds will be able to be put into. And when I've worked on this in other regions, this has been an important part of what the World Bank does, is to be able to set up some sort of technical assistance or other type of facility that will be able to support persons who need capital, entities, etc., in designing robust, bankable projects that these resources can be used for.
And Harry, for you, what leaps out?
Well, obviously, I saw lack of a carbon price and thought that was a comment of real brilliance, and I can't think who put that there. But apart from that, I'm really following on the colleagues. I mean, regulation.
Yeah.
And in a way, that's a bit of an easy term because it captures so much. But I think if you think fundamentally, I mean, we know that in the right circumstances, private markets work. If you create the right structure, private money flows and it delivers results efficiently. And you see, so many examples of that. I mean, I often think of supermarkets, right? Supermarkets deliver an incredible variety of an absolutely fundamental commodity, which has a short shelf life in many cases, to doorsteps across the world, not everywhere, I appreciate, but in many, many countries across the world, with amazing variety and very low profit margins, i.e. very efficiently. That's an example of private sector working to provide an absolutely fundamental public good really, really efficiently. So, one question I sometimes challenge myself is, why can't X sector be more like supermarkets, more like the food sector? Recognizing there are still some big problems there. So I think it's really, what you really want to do in emerging markets, and the World Bank does this, and we try to as well, which is create a regulatory framework which delivers the right incentives to the private sector. Because we know that if you do that, then you get the right example, then you do get the investment you want.
We're going to talk in more detail about that in a minute, but I wanted to return to what you really highlighted straight away, because I think that some investors just find emerging markets a bit scary. What would you say to them? What appeals to you about emerging markets?
Yeah, and BlueOrchard specializes in emerging market investments. Actually, we only do emerging markets, and we have quite some track record. And I think in our discussions with investors, I think that track record is the key argument to convince investors to come in, right? And also in our experience, one of the key issues when private investors look at investing in blended finance vehicles is the performance and volatility of that performance, right? Or what they are seeking for is really lack of that volatility, and being able to demonstrate track record is something that's really a powerful argument to convince investors in developed markets that emerging markets are not all that bad for investment.
And what are the other key conditions that you like to see before you invest?
Yeah, I think, well, first of all, what we'd like to see in blended finance in particular is the scale, right? Because very often we see funds of a relatively small size, $100 million, where public investment would be 20–30%. And as you can imagine, with a $100 million fund, with all the diversification requirements, right, with concentration limits, we actually end up with relatively small investments. And that is really something, that's a factor that holds back development, and that holds back ability to scale it up.
Tariye, can I bring you in here? Because I know you've only been in the job for a few months, and I just wonder, since you've started, what your first impressions have been, what you are finding is working and isn't working.
Thank you so much, and indeed I've been at the SIF for just over 6 weeks now, but I've been in emerging markets finance for over 20 years. And 17 years in infrastructure across the entire risk spectrum, and also structuring a lot of blended finance and integrated syndications across sovereign and private sector I think one of the areas I would like to really pick up on, it links somewhat to Harry's point, I will land on it in a moment, but it's very important to think about two forms of de-risking. There's a form of de-risking which is toward the crystallization of pipeline, where we may have projects in sectors that are relatively new, or in sectors where the viability of the project is still about 10 years off, and we are seeking to accelerate commercial viability. The CIF was formed in 2008 with the objective of accelerating the commercial viability of solar, wind, effectively mainstream technologies today. And currently we're going to be doing same with the newer technologies, for example, in industrial decarbonization, battery storage, and the like. And there's a type of de-risking that is needed for that form of crystallization of new projects or sectors that are somewhat further away on their investability curve. There's also the role of concessional or catalytic capital in scaling more proven solutions. And this is where the private sector has a significant role to play because of the hundreds of trillions of dollars of capital out there globally. So this is the capital that we need to move from international markets into emerging markets. And that's a key subject today. How do we get that money flowing? And so the de-risking is really to address not only the perceived risk, but areas around streamlining where there is a lack of awareness, as mentioned, as to the sort of project framing, and to the extent that we can start streamlining projects so that they're more bread and butter, speaking to Harry's point about retail, is that we need to get our climate action and effectively blended finance solutions to be so streamlined that international capital can feel comfortable that it's something they've seen before and they can replicate and they can effectively create systems to continue to invest. And even the use of blended finance in that space needs to be more standardized. And so the role of creating standardized blended finance instruments that are framed and that are understandable, and there's a language for it in order to be able to scale proven solutions and to take us into more bread and butter blended finance, for which the trillions of dollars globally can start to think about allocating to emerging markets, is a very big piece of the puzzle.
Tariye, just briefly, everything you've said sounds really quite exciting. Would you say your approach at the CIF is quite risk-taking and innovative?
Absolutely. I mean, the CIF is one of the largest pools of concessional finance targeting climate action and working with the MDBs as a system with a focus on the pillar A that I mentioned, which is supporting MDBs and effectively providing the underpinning to allow them take bolder steps in technologies that we're seeking to accelerate their commercial viability. At the same time, we also have very strong use cases of blended finance solutions that have successfully delivered more proven solutions, and the objective is to therefore provide underpinning to scale those. The CIF money is money first out the door. It's money that's most patient. It's money that takes its positions or takes its repayments last, and it's monies that can serve as grants or the most fundamental, or taking the most fundamental risk. The MDBs, as well as countries, through this partnership and alliance, have very much benefited from this critical form of capital into delivery.
Rolande, you're nodding a lot and smiling at what Tariye is saying. But can you take us through what the role of the World Bank is in this space? And kind of what resonated with you with what she was saying?
I mean, everything, right? In the sense that the CIF is an instrument that, as an operations person, I have not dealt with Tariye. She's only been there for 6 weeks, but we have been utilizing CIF resources, concessional resources, blending them with our IBRD, IDA resources from the World Bank, IBRD, International Bank for Reconstruction and Development. I'm sorry that I'm using acronyms, but we are using these concessional resources along with our existing, some of them concessional through the International Development Association, others of them less concessional through the World Bank or IBRD resources to do innovation, as she mentioned, but also some of this sort of bread and butter expected infrastructural type work, and beyond infrastructure also. And so it's really interesting to have come from an operational perspective where we've been able to utilize these funds to be kind of having a more esoteric conversation now. But maybe I would say to you that as MDBs, where we have been trying to support this process, it is very much about, as Tariye has mentioned, this making it bread and butter, making it more comfortable for investors, right? So it's creating an enabling environment, using language that they understand. And so in the first instance, with a number of global institutions, we have worked specifically on the blended finance framework and common standards for mobilizing finance with the OECD, for example. And then there are, sort of three other buckets that, maybe I'd like to speak to. First, the climate policy frameworks, fancy language for, the nationally determined contributions, the, national adaptation plans, long-term strategies, where we enable countries to sort of sit and think about what is the policy direction, what is the policy ambition. And this gives a sort of very clear signal to investors that countries know where it is that they would like to go. And therefore, it gives them a clearer path and greater comfort in being able to sort of step in and determine as well what are the sectoral pathways that are climate resilient and what are the low carbon development pathways. The second speaks a little bit to the regulation that you spoke about, Harry, developing economy-wide regulatory frameworks that set the preconditions for sustained mobilization of private capital. And there we're using those buzzwords of green taxonomy and things of this nature, where nowadays we're doing it in every country so that when the investors show up, they understand the language that we're using, they're comfortable with that language, and therefore they're ready to move ahead. And the countries are also therefore signaling that we are ready, we know what we have to offer, and we can speak to you in your language. I think lastly are the sort of broader sectoral regulatory and legal frameworks that we try to put in place to create an attractive environment to draw in private investment. And these should not be underestimated because in our view, we have seen how very much this helps to accelerate investment. We are doing these things, but also other multilateral development banks are doing these things like the EBRD.
Normunds, I think you should give us an example now. We've got to that point in the conversation of what's working in this field. I mean, we've heard lots of language about things that need to happen, challenges, but what have you invested in? What have you seen that's worked?
Indeed, and I think for blended finance funds and to be able to raise significant or meaningful amount of private capital, there are two key ingredients in our view. One is it's a junior capital, right, or first loss, if you will, whatever term you want to use, that really gives comfort to investors that coming into that into those emerging markets, right, there is a de-risking piece that allows them to be more comfortable, right? That is one critical element. The other very important part, especially when it comes to technologies that need to be deployed in order to achieve the objective with the financing that funds are providing, it is technical assistance, right? Because we really need to understand that technology, that know-how may not or will not be available in those particular occasions. So having junior capital at a meaningful amount, which probably is about 20–30% at the minimum, what private investors would expect, right, underneath them, and having a technical assistance that addresses the issue to allow appropriate deployment and building the pipeline, right, as it was said. Those would be two critical elements in our view to see blended finance funds grow.
We're going to talk more, I think, about the pipeline and getting the money flowing in a minute. But Harry, can I ask you what the EBRD can offer Normunds, other people who are wanting to invest? I mean,
we try and offer a full spectrum of things. If I start with the upstream, what we can offer Normunds, we hope, is work with the governments to try to create a regulatory environment which becomes more attractive to him and creates the business opportunities for him. I'll give you a classic example of what we do, which is we promote renewable auctions. When a country has a certain stated ambition for renewables, we come to them and we say, okay, here's our help to try and turn that into reality, and we help them create the framework and the structure which then delivers a project which is bankable. So that's one thing we do upstream. The second thing we do is that we can ourselves take risk. we have a mandate only to operate on sound banking, so we need to earn a return that reflects the risk. But we have an appetite for the sorts of risks that not all investors do. In particular, we have an appetite for political risk. So we're willing to go to countries that are maybe not in the best shape and stay there and see through the long term. And in particular, we can take a view on a short-term risk because we are confident that the long-term perspective works. So we can participate in your funds if the returns are good enough, and if we're attractive enough to you. And then the third thing we can do is we can mobilize concessional finance and the sorts of first-loss risk-taking cover that you talked about, because that's part of our role. And in particular, because Tariye is here, I mean, the CIF is a great partner for MDBs. It's been, I think, the most effective climate fund as a partner in partnership with the MDBs, because of its ability to provide that type of the most valuable capital, the most risk-taking, the most long-term capital. So those are the three things we can do. We can create the business environment, we can provide our own capital, and we can mobilize the concessional and donor capital. Is it attractive? Am I selling
what do you make of Harry's pitch there?
You're not convinced yet.
It's all right, we've got another half an hour for him to convince you. My Slido is quiet. Have anyone got a question in the audience before we move on? No hands raised? Don't forget you can message me and I'll make sure the questions get to the panellists. Tariye, did you want to chip in there? How did you find Harry's pitch?
Oh, I thought it was great. And thank you so much. Thank you so much, Harry, for your words of support and encouragement. EBRD has been a phenomenal partner as well. And, for us, one of the key the hallmarks of our value proposition is that we're able to work through the MDB system. And why this is critical is that it actually enables us scale. Because we don't have to build our own systems. We can rely on the broad reach of the MDBs, like the EBRD, as well as their systems, processes, and we're able to create a very strong network effect. And this is really going to be an area of I think, reflection for the climate finance architecture broadly, is really about how do we scale concessional finance and how do we collaborate and partner most effectively. And the CIF has a framework for doing this, and we only want to make it better and more effective.
And collaboration is one of the big words of the day, I think. But Tariye, you mentioned in your very first answer that you wanted to talk about how we get the money flowing. What would you like to see? What needs to happen?
Well, I think it's I'm sure during the conference as well as in this panel, it's very clear that private capital is a very critical piece for the next era. And, the reality we find ourselves in is a coming of age of climate finance, where the last 15 years was about establishing, proving, framing, and now we need to scale. And private capital is a very critical component of scale. It's going to be a key driver. And so the need for this collaboration to involve both the emboldening of MDBs, but really MDBs being able to integrate private capital into a very sustained and quantum-based approach is something that I would very much like to see, and that the CIF is going to be working very closely with the MDBs on how we identify appropriate instruments as well as partners, so that 15 years from now we can say that this was the era of private capital very much moving in to take up the areas that were best suited for them.
Can you see a more specific way as well the different players could work together if we talk about collaboration? And Tariye just raised it as well.
No, certainly. I think we at the bank, we support programmatic, system-wide approaches to designing and implementing development programs for these emerging markets. And I think, again, I often refer to our fancy language, right? I think the best way is to give an example or give a couple of examples. And so we have this Sustainable Renewables Risk Mitigation Initiative, where...
That's quite an acronym, I'm sure.
Exactly, which is why I'm trying to leave out the acronyms. But where we essentially are, we're going to be scaling this to a second phase because it has worked relatively well. We've used about $280 million in grants, highly concessional loans, and risk mitigation instruments from the Green Climate from another partner, and blended these with about $1.3 billion of IDA, as I mentioned before, International Development Association, and EBRD resources. This essentially we've leveraged into about $3.3 billion worth of financing. Wow. And what are we going to get for that? Because, you know, I'm not here to just wow you with numbers, but really more so with results, right? This investment will go across 7 countries. It is expected to build 2.5 gigawatts of renewable energy in different renewable energy projects. 1 gigawatt of battery storage, something that Tariye mentioned, as well as kind of, you know, relatively newer technologies. And increase access to reliable and clean electricity for over 4.2 million people, right? Those are real results from doing a lot of, you know, financial engineering, chatting with a number of folks, finding out ways that we can use guarantees, et cetera, et cetera. We are actually able to bring it right down to the projects that are going to mean something for people. I think I'd also like to use as an example some work that we're doing in Uzbekistan, which is, of course, one of the most energy and fossil fuel intensive countries in the world. The bank is using climate finance to help the government mobilize private capital. We've signed what, in our view, is a relatively modest agreement, lending agreement, for $46 million with the government. It's financing emissions reductions in the energy sector, incentivized by energy subsidy reforms, right? Our main focus here is to motivate energy efficiency. The reforms will drive changes and specific energy sector investment. Under the project, the bank will purchase between 2 and 2.5 million tons of CO2 reductions, and the country will be able to sell the remaining emissions reductions on international carbon markets using the systems, infrastructures, and processes established and tested in the project, right? So if you take away, in my view, what are sort of the 3 key big words that one would find on the word cloud, leverage is a critical word, partnership, because we are partnering with a number of different financing institutions, but also building capacity. That capacity then, you know, the country then knows how to, or has built the muscle to be able to use this and do this for themselves going forward.
Everyone in the room starting to collaborate because I'm getting some questions. And this one I'd like to ask you, Harry, because we were going to come to it during the panel anyway. How can country platforms help?
Famous country platforms. I was talking about this earlier, and I said we should have copyrighted the phrase when we did the first one in Egypt, and we're making a fortune because whenever you go to these international gatherings, everybody wants to talk about country platforms. I mean, country platform, sometimes people are talking about it as if it's this, you know, tightly defined, patented term that, you know, you either are or are not a country platform. Truth is, it's just a broad concept. But what does it articulate? It articulates the idea that if you just keep going project by project, it's water on sand. We're not going to address the problem. And you saw the video earlier. It talked about 2.4 trillion annually needed. That's the figure that came out of a Songway Stern report, and it's broadly accepted as the scale of investment need to meet climate goals in low and middle-income countries, excluding China, by 2030. That's huge. And we're only at 600 billion annually now. So you've got to get 1.8 trillion more investment. And that far exceeds even the World Bank. Even the World Bank can't do that much. And even the CIFs, I mean, there's not that much concessional public money available. So the only way you get there is by scaling up. And if we go project by project, we don't do it. So what do you need? You need a systemic impact. You need a systemic change. And that's what the country platform tries to capture. It says if you package together, or if you articulate a narrative which brings together country ambition, policy reform, because the starting point is that the regulation isn't there, otherwise you would be having investment. So country ambition, policy dialogue, donor finance, some form of concessional grant finance, MDB finance, but also MDB brokering, MDB support, MDB filling in the gaps to bring the whole thing together. And then most importantly, after the country ambition, the private finance, the private investor appetite. If you bring these things together, you have an outcome which is great, where the whole is greater than the sum of the parts. That's the underlying concept, and you can see it being applied or tried to being applied in a number of different areas. we, EBRD, have had some success in supporting Egypt with the NOEFI country platform. It's a work in progress. But I think we're, if I can be a bit boastful, we're pretty proud of the results so far, and more importantly, Egypt is pretty proud of the results so far. But we have to keep doing it, and we have to keep replicating it, because if we don't, as I say, we're not going to get to the outcomes we need.
I mean, you're excited about it, and you're very ambitious for it too, but let's sort of zoom in into one specific example, because, Tariye, I know you've been working with the EBRD on a country sector platform in North Macedonia. Can you tell us about that?
Sure. No, thank you so much. And I really wish to second Harry's points really about country planning and the coherence that it brings, in that CIF is a country-focused, programmatic-focused organization where country planning is at its core, and a platform could be across sectors, it could be within a program, but what's core to it is coherence and really being able to tackle multiple aspects of the impact that you're trying to achieve versus dealing with project by project. And so, for example, in the case of North Macedonia, we recently approved under the CIF's Accelerating Coal Transition Plan an $80 million or $85 million investment plan to support North Macedonia in their transition from coal to clean energy. Now, our Accelerating Coal Transition Program was the first ever multilateral coal transition program. It feeds into the well-known Just Energy Transition Plan construct. CIF actually served as a secretariat for South Africa, but at this point, much of this has very much grown. Indonesia has a JETP, and we also have some of those other countries as part of our ACT program. But North Macedonia is the most recent. We've done it in partnership with EBRD. At full implementation, we're expecting to generate about 1 to 7 in terms of co-financing by 2030. We're expecting to have EBRD contribute about $600 million, as well as the World Bank. World Bank is part of this as well as the public and private sectors, just exactly the way Harry outlined the nature of the alliance and the coherence and how that fits into the country strategy. What's very important about the North Macedonia ACT program is that it really addresses multiple components of the intervention. So there's the repurposing of coal plants, there's integration of different forms of energy solutions, there's the just transition component, there's policy, there's regulation, and so ideally we end up with a high impact, very coherent project or program rather that yields this capital mobilization as well as the ultimate objective, which is the accelerating of the coal transition.
I mean,
Lucy, sorry, just to come in on that. I mean, that's a classic example of what we're talking about. 85 million is a lot of money, especially when it's sort of highly concessional grant. But you can lose it really quickly. I mean, you can spend that in a couple of years on some nice trophy projects, and what have you got? You've still got as North Macedonia currently has, a highly coal-dominated system. If you package that, and that's the seed capital, if you like, because it's the cheapest. It's grant and highly concessional. If you package that with a commitment to coal exit, the development of a national energy and climate plan that's consistent with EU principles and EU law, the development of renewable auctions, a commitment to invest in the grids, and you bring that all together, then you get real impact. I'm not saying we're going to do it, it's challenging, it's really difficult. The coal transition is really hard. But that's the underlying philosophy, which is to take the really super valuable but quite rare money and amplify it by integrating all the other elements.
We've mentioned Egypt, North Macedonia, Uzbekistan's come up as well, and there's a question here about the different requirements for different regions. Do they change, Harry? Does the EBRD have to...
Oh, for sure.
Yeah, okay.
Yeah, I mean,
take us through that, and also the question specifically asks, what about Africa?
Oh, well, okay. So, I mean, firstly, absolutely. I mean, you always say the first thing anybody ever says about country platforms is that they're country-led, country-driven, and every country is different. Even in the Balkans, say, which were once all together as part of one political entity. Of course, you cross a border, and so many things change. So, I think all MDBs would agree. I mean, you have to be responsive to the specific country you're in and work like that. And to be honest with Africa, I mean, EBRD is active in North Africa. will shortly be active in sub-Saharan Africa, but I would defer to the World Bank, frankly, to say more about what the specific challenges Africa. I mean, they know far more than we do. I would look stupid trying to lecture.
No, and I mean that's the region that I was in, coming in. And I think the challenges are pretty much the same. I led with the pipeline, the financing of the pipeline, because that was something that just kept coming back, that there wasn't, even with a government that was leaning forward, which I had worked with before on all of this climate action, on trying to raise private finance, et cetera, the projects were very difficult to come back.
The lack of the pipeline is the biggest barrier.
The lack of the pipeline was one of the biggest barriers, but also the cost, right? I mean, everybody says, climate money. It turns out that for Africa, that money is still quite expensive, right? I mean, you have the opportunity to use SIF funds and others, but the perceived risk is very high. There are real risks, but I believe the perceived risk is very high. And I was having the opportunity to chat a little bit with Normand, who, of course, spends, day and nights with BlueOrchard working in these areas. And one of the things that he talked about was bias. And I think that is a real thing, right? That persons are not aware, and they come to particular destination countries with a sense of bias. And some of it is a lack of awareness, but some of it is also bias. And so overcoming that perceived risk is important.
So what's the most important thing that could happen to help overcome that perceived risk? Because you've all slightly referenced it as well.
I think if I had an answer to that, I wouldn't be with you, right? Okay. I mean, I'd be earning lots of money somewhere else, quite frankly. But I believe it's exposure, right? As we deal with sort of bias anywhere, you kind of have to open the doors, you bring them in, you show them what's happening. You have opportunities like BlueOrchard, where they have funds that have invested in emerging markets and have consistently given non-volatile but strong returns. And that's the sort of thing that speaks to a good investor, right? And they speak a language that those investors will understand. And I think some of the, in my initial intervention, when I spoke to what are some of the things that we do from a regulatory perspective at the sector level, at the economy-wide level, et cetera, it's about serving it up in a way that investors can relate to.
I've got a specific question here for you, Normunds, on Slido, but before I move on to that, do you want to respond? Because, people are looking at you, talking to you, and you're the man, at the heart of all of this. In terms of what's just been said, what's the most important thing you've just heard?
Yeah, maybe if I may come back to the deferred question to what Harry mentioned earlier, right? And I think very important thing is the right incentive. Incentive in general, but the right incentive in particular, right? And to me, this is really what makes the difference in this blended finance world. And I can think of an example in early days of green financing, biogas from different region, right? Because it's in tropics. But the incentive that was created at the time was basically a refund on the principal and interest if for households the biogas equipment was put in place and launched, right? And what it really did at the time, it created the demand because there was financial incentive for the end users. What people hadn't thought about is how do you sustain it, right? An incentive that should have been put in place was to commercialize the ecosystem. No? Because, money was spent exactly as it was discussed here, right? The money was spent, the refund was given, and the biogas thing didn't work because masons were not there, you couldn't maintain it, right? And 2 years later, there was really no real benefit. So the right incentive is really what is needed. And secondly, infrastructure, right? As these technologies become more and more complex, you really want to make sure that there is a opportunity and there is a skill to deploy and to maintain, and this is where the financing would really be important. And then on the investor side, it's the same thing. It's about the incentive. When you think about the blended finance funds, they're typically 5, 7, maybe 10 years, and to have a real impact in climate change, that is way too short. No, you really need to have a commitment from investors. You need to have patient long-term capital that is available for private investors to come in and gain that confidence that indeed these sorts of investments have been commercialized or can be commercialized.
Would you say, in answer to this question on Slido, would you agree that the absence of blended finance regulation in emerging markets is one of the key risks? Any of you? No, I mean, to any of you, because the question is specifically on this and how that gap can be filled. Harry, would you like to?
I'm not sure. I mean, I'm not sure what it means, the absence of blended finance regulation. I mean, is that getting at there should be some discipline over the use of blended finance, for sure, because we all know examples, which we're all too polite to recite, of blended finance being abused, frankly, and creating distorted incentives or just being wasted. So, I mean, that's one of the things that EBRD takes very seriously. I'm sitting under the scrutiny of some of the people who are the guardians of blended finance. But, we do ask ourselves, we do challenge ourselves internally as to the use of it to make sure that we're delivering value for money. But also, one of the critical questions we ask is, if you're using this blended finance, what is it about this structure, this intervention, and about this project, which means you won't need it in the future? Because it just doesn't work. If we go to Tariye and say, can we have, 100 million for this particular program, and this will do this much, and it'll open up this sector, and in 3 years' time we'll be back for another 100 million for exactly the same sector. It doesn't work. As we keep saying, we don't have that much money, that much concessional grant money. So I think, again, I'm not 100% sure I'm answering the question, but I'm interpreting the question as saying, do you need to have discipline and regulation, or some form of guidelines as to how you use blended finance?
I think the question is there an absence of that kind of regulation?
No, I think MDBs, well, probably, again, mixed views as to the effectiveness of these guidelines, but MDBs expect from themselves a certain rigor, and for sure, people like CIF impose a discipline on us, and ultimately the donors impose a discipline.
Normunds, how about this? How can large asset managers invest in private credit emerging markets, since that space does not exist? What blended finance solutions would make a difference?
They certainly would, right? Because, as I've said before, public-private partnership in starting new opening up investment opportunities in new asset class are important, right? And private sector would look not only for regulation, right, but also for financial commitment to protect at the early days, protect the private capital until the particular asset type can be commercialized, right? And again, it goes back to types of funds that you would see in climate investment. I have to say, from our own experience, at this point in time, the most efficient deployment is through public funds, right? We do a little bit in private debt and in private equity, but what really investors are looking for, blended finance is new to them, right? And emerging market investments and climate investments are liquid in nature, but investors are looking for liquidity. So structuring funds in a way where there can be liquidity provided to the private investors while still making semi-liquid or liquid investments is something that really makes the difference in selling these products to private investors.
Is there a way, all of these questions are anonymous, none of you wanting to put your names to it, in which ways can philanthropic funds be most useful in mobilising private climate investment alongside institutional funds, and is there any particular focus here? Rolande, can you?
I would say it just depends upon how it is that they would like to utilize those resources, right? I mean, they could set up structures that would be similar along the lines of a SIF structure and utilize their funds in that way. And I've seen how more and more philanthropic funds are sort of stepping in to do very practical. To do very practical things and to be working with MDBs. There was a time in development where we didn't have that as much, right? But now more and more, we're setting up trust funds, etc., and we're being approached by philanthropic organizations who are saying, we have resources, we would like to target these resources to this particular place. Can the World Bank be a vehicle for that? And, clearly we're open. We would like to have those resources, and we use those resources in, I would say prudently, very much in the way that we use other resources. We have a lot of other examples to be able to define the rules of the game for those philanthropic.
And any specific climate focus areas, would you say?
At this point in time, I would say no. Mm-hmm. People want to do good. They have lots of money, and they sort of come in and want to know where those resources should be used. I haven't seen a sort of drift towards, one specific thing, whether it be infrastructure or something else.
Harry, how would you describe the financial performance of EBRD climate transactions for the syndication partners in the room?
Oh, spectacular.
Hashtag.
I really think you wrote that question.
Would you like to elaborate on that?
I'm just currying favour with colleagues. No, I mean, look, I mean, EBRD's credit track record is good, especially when you think about market. And it goes to the point about perceived risk. And I think some of that is structural. I mean, we have some structural features which allow us to have a good credit record. I mean, we don't have pressure to sell out of transactions. Commercial banks, if a deal goes sour, they often can't wait for it to improve, whereas we can. I mean, I personally was involved in a wind farm that went wrong, and the commercial banks exited and crystallized a loss. We stayed with it. Market recovered and so on. So we have some structural features which help us. I'd like to think the business model of EBRD, but also MDBs in general, is quite helpful. I mean, I remember in the financial crisis when things were all collapsing, and I was talking to some friends who didn't really understand the EBRD business, saying, well, are you about to go the way of all of these other banks? And I said, no, we have this really odd business model. We've met our clients. Some of them even have assets, and we stay as a lender with them. And actually, old-fashioned banking like that,
I'm sure you took great pleasure in saying that, Harry.
Yeah, well, having had 10 years of watching them earn a proper bonus, I took great pleasure in doing that. But no, so I think, those reasons. The other thing I think fundamentally is, climate transition is a good business proposition. If you think about, what is the climate transition? At a first order of approximation, it is moving from an energy system dominated by fossil fuels to one that's dominated by wind and sun. That's a very big picture summary, but it's actually, as I say, a first-order approximation. It's the essence of it. That is moving from an unreliable, expensive, volatile energy source to a reliable, affordable, stable one. It shouldn't be a surprise that investments based fundamentally on that thesis make sense and do well in the long run.
Any questions in the room? Any hands? Yes, here at the front. Two, in fact. It should be on.
Hello.
Hello.
Yeah, Andy Leonard from the Texel Group. It's a very interesting discussion in the sense of there's a juxtaposition here between a social good that should be subsidised and a private investor that's looking for the maximum return. And surely there should be funds available to subsidise the private investor who then can leverage that investment, whether it be through insurance, whether it be through private investors, so that leverage can then be applied to the goals that you're looking for?
Well, okay, I work for a transition bank, so I'll answer that. Yes, for a while, but the long-run goal is that the private return should match the social goods. I mean, in a well-structured market, if you deliver a social value, you earn the appropriate return on it. So, and that's what EBRD as a bank found, its mission is to make the transition to a well-functioning market economy. So in the long run, you shouldn't need those subsidies. But unfortunately, we're very far from that perfect well-functioning market. So absolutely, in the short run, there should be those subsidies.
Then the discussion is, do you believe in shareholder capitalism or stakeholder capitalism? I mean, a private investor is always wanting to give back to a shareholder.
Yeah, and we believe in the power of that motivation to deliver efficient, social good, public goods. Now, in the meantime, you might need to subsidise. You might need to transfer value to shareholder. I mean, but when you do a first loss facility, that's what you're doing. You're reducing the cost of capital for the private investor, and we recognise that is a second best solution. The first best solution is a well-functioning market. If there's a well-functioning market, you can get rid of the MDBs. We'll have to look for jobs, Thomas. But and that's the ultimate goal of all MDBs. Is to in the long run, all MDBs would like to be out of business because we wouldn't be needed. But unfortunately, we're a long way from that. And in the meantime, yeah, of course, you need to put subsidies in, and that's the role of the concessional fund.
Rolande, did you want to add? No, I'm coming to her in a minute. So did you?
I'm happy to.
Yes.
Hi,
Tariye has her hand.
Oh, Tariye,
so
sorry. Oh, she does. Look.
Yes,
hello, Tariye. Sorry, I didn't see the little hand in the distance.
Yes.
Just one moment. I'll come back to you. Yes. Yes. Tariye. Yes, please do. I'm sorry, I missed your hand from where I'm sitting.
At all. It was actually in response to Andy, and good to see my friends from Texel in the room. Andy, please say hi to Simon from me. This question does come up quite a bit from the private sector. I've had the pleasure of working with Texel on a pretty large syndication and benefited from a lot of the insurance solutions that they've provided. And I think I would almost like us to look at this slightly differently, which is that, yes, addressing climate change there's a massive social good to it when we look at climate change as really being one of the greatest threats and challenges of our time. But I also say that climate change presents one of the greatest opportunities of our time. And I think Harry was spot on when he spoke about the fundamentals of a lot of the projects, the fundamentals of solar and wind energy, the fundamentals of battery storage, the fundamentals of having more resilient transmission systems, smarter grids, and how that is very much akin to private capital utilization, presenting good quality returns, and there really should be no subsidy over the long run. However, in the short term, there may be perceived risks. The reality is that in OECD markets, these are no-brainer investments. However, as we're going into emerging markets, the types of risks we're dealing with might be tied to political. Big risk right now is macro. And I think that was one thing that we didn't talk about much in the conversation was foreign exchange risk, interest rate risk, especially with what's happening in the global markets. But ultimately, the macro risks within the country and how those are managed and how those affect returns and the staying power through the volatility of the macro experience, even though a project's fundamentals are sound. These are the areas that private capital really should be intervening, but with the support of blended capital. We have some very good experiences in Africa of blending the use of guarantees to crowd in domestic pension fund capital into renewable energy. These projects were sound, but the projects were new. And the guarantees in the form of a wrap were used to get these pension funds to learn, to test, to experience. And it's been very interesting to see over the last few years that after pension funds have a first positive experience, they're often willing to invest uncovered. And we need to do more of that, is effectively using blended finance as a stopgap that effectively trains, establishes, creates familiarity, and allows private capital to continue without it. But of course, in certain areas such as macro risk, you may have to have, or political risk, you may need a continuous support. There will always be a role for MIGA. There will always be a role for the regional development banks such as EBRD and their solutions in respect of political risk cover. And there will always be some additional requirements around potentially making hedging costs more affordable. SIF has played a big role in that, where we've actually provided cost reduction solutions in respect of hedging solutions so that more local currency can be provided. And so these are really the areas that we're seeking to unpack risk and address risk so that that opportunity can therefore be realized by private capital.
Tariye, thank you. Before we come to our final question from the audience, I do have one more question for all of you. We've got a final poll. Just from everything that you've heard so far in today's discussions, I wonder what you all feel is the key thing that collectively needs to be done differently. So, no, the top one there. What do we need to do differently is what there we are, Pryce, fossil fuel impacts. It's already getting some answers in. So if you could just have a think about that question while we take yours. Yeah.
Sorry for not using Slido.
No,
incredibly wordy. I type out my questions as minus 246, so I get stuck with the mic. Thank you so much for an incredibly interesting panel. And I want to walk away a little bit from renewables because they become the elephant in the room. And blended climate finance is also energy efficiency. Very often, we're looking for climate finance to make a lot of unsexy energy efficiency projects bankable. And there we had two forms of subsidy crimes. One side is, if climate finance is too much and distorts the market, that's rare so. But very often in countries where we got climate finance and MDBs trying to create a market for energy efficiency investments, we got public sector making energy the social good, which you guys were talking about. And especially energy subsidies often supporting, coal-fired electricity and giving it all sorts of social objectives, political, popular, social reasons why it has to continue and go on one hand on the tariff elements. On the other hand, coming in for example, climate purpose, naming it for climate purpose, and giving 60 to 80% grant subsidies for previously bankable energy efficiency projects and distorting the market again. I understand that's not what the climate financiers are doing, but with MDBs on board, with organizations like CEF, EBRD, World Bank on board, can there be a political discourse with the country governments to kind of contain this distortionary subsidy to make sure that we're not throwing 30 years of development assistance away, where we built those markets. I've spent 25 years in this sector. We created energy efficiency markets, revolving funds. World Bank was there, AID was there, EBRD was there, MIGA was there. We created ESCOs. And now all of that is going down the drain because there's 80 to 100% grant financing for energy efficiency.
That definitely wouldn't have fit on a Slido, but it was very good to hear you outline that problem. And very quickly, Harry, what do you think about the sort of suggestion of a discourse between?
Yeah, sure. It's all about subsidies, right?
Yeah.
I always find it extraordinary when, developed world countries say that we can't, we only have a limited amount of money to give to Tariye or for her to give to us, and so on, or to the Green Climate Fund or whatever. And then, agriculture subsidies in the tens of billions.
Have you seen the word cloud as well behind you?
Yeah, I may even have written one of them, actually. But it goes back to the point about markets. The first goal for all of us should be get the subsidies out, get the right price signals, and then things will flow. And everything else we're doing is really just trying to mitigate that. The challenge is, and we're all responsible for, we're all implicated in this. Eliminating subsidies is politically very difficult.
Rolande, just looking at the word cloud, pick out the one thing to close this session on that you would like people to perhaps leave this session thinking about. Think long term. Collaborate more. Mindset change.
Maybe educate. Maybe engaging more investors. I don't see awareness there in the same way, but yes, raise awareness. I think that there is still a lot to be done in that area. Bringing people together. I wanted to make the point on subsidies. All I would say to you is that our macro guys are fighting the good fight with the governments all the time on eliminating subsidies, but countries are in the lead, and it is politically difficult. And sometimes you have to do a little bit of a dance, right? You have to sort of go in with the thin end of the wedge with a view to making the change after you've built the trust. And so nobody would reject what you've said, but I think people would agree that it's harder than we think to try to address those issues.
Thank you all. Thank you for your contributions to today, to the word cloud as well. I hope that you've gained a lot from the session, that the conversation will continue amongst you all and with our panellists too. Enjoy the rest of the day, and thank you so much for joining us. Thank you, Tariye.